The day-to-day activities of banks give rise to a wide range of risks. This can be more effectively managed by allocating them to risk types, which is a classification system used to collate individual risks. There are, in general, 7 main risk types to which all banks have some level of exposure. Each of these risk types can be further broken down by a number of subtypes. Credit risk is the risk of loss due to a borrower or other obligor failing to settle amounts due for payment. Credit risk can be further broken down by retail credit, counterparty credit, and wholesale lending credit, for example. Market risk is the risk of loss due to changes in market prices or rates. Market risk can be further broken down by market trading risk and market non-trading risk. Operational risk is the risk of loss arising from inadequate or failed processes, people, and systems, or from external events. Operational risk can be further broken down by data, technology, model, or human capital, financial reporting and regulatory reporting risk, etc. Compliance risk is the risk of non-compliance with regulatory requirements. It can be further broken down by prudential regulatory risk, customer compliance risk, market practice risk, financial crime, and fraud risk, etc. Liquidity risk is the risk that a bank is unable to fund an increase in its assets or meets its obligations when they fall due. Strategic risk is the risk of poor or inappropriate strategic decisions being made. And finally, reputational risk refers to the risk of damage to a bank's business operations, such as its ability to retain existing customers or attract new customers, or its ability to obtain funding as a result of fines or other actions that result in adverse publicity. Note that this is not an exhaustive list, and other risk types include climate risk and conduct risk, for example. So why do banks categorize risk types? Banks categorize risk into different types for many reasons: setting risk appetite, risk acceptance criteria, and risk policies, or allocating resources, building up expertise, and aligning with the regulatory requirements on risk measurement and capital, or defining responsibilities. The most common risk organizational structure has separate units with responsibility for managing credit, market, operational, compliance, liquidity, strategic risk, etc., within an overall group risk structure. The Chief Risk Officer, so CRO, has overall responsibility with a group head for each risk type reporting to the CRO. The main disadvantage of using risk types is that risk silos, in which risks are looked at and managed from the perspective of one risk type only, often occur. This can result in policies and processes being developed in isolation, staff expertise being concentrated in only one risk type, interlinkages between risk types not being recognized or addressed, risks that do not easily fit in a risk type being overlooked or not properly assessed at all. To address this, the staff are encouraged to broaden their knowledge across all major risk types and to work with colleagues on a cross-risk basis. For example, when they are assessing risk for new products. This is part of the reason why banks have adopted an enterprise risk management approach to manage risks, as it is intended to foster a more integrated approach to risk management. Thanks for watching. In the next session, we'll be looking at risk types and regulatory requirements.